Okay, here we are back to our adjusting entries. And we want to look at the second kind of an adjusting entry. And I'm going to look at the other side of the entry we looked at in the last example. And the last example involved rent. The last example involved us paying money in advance. So in example 1 of our adjusting entries, we looked at us paying money in advance of services to be received over time. I'm so sorry about the handwriting. I'm glad you have the voice to go with it. And the example was we paid rent. We paid rent, right? It was $600 in rent. We paid rent. $600 for 6 months. And our picture looked like this. $600 goes out. Here's our timeline. And over a period of 6 months, we have month 1, month 2, month 3, month 4, month 5. Here's month 6. And we were saying that we need to recognize $100 in rent expense every month. So when preparing monthly financial statements, we need to make adjustments. To pick up, to reduce prepaid rent, when we recorded it, we debited prepaid rent, $600. We credited cash because we paid in advance, $600. Now, let's use the same thing. Let's go to the other side of it. I'll use the same color here. Instead of us paying money in advance, what about if it's us receiving money in advance of services to be performed over time? Scribble, scribble, scribble. Well, I'm going to take the same exact example, but I'm going to look at it from the perspective of us being the landlord now. We receive the $600 instead of we pay the $600. So what's the diagram going to look like? We're going to have plus $600. We receive it. And we haven't earned it until 6 months have passed. So here's time period 1. Let's follow this down. Here's time period 1. Here's time period 2. I think a picture is helpful. Time period 3. Time period 4. Time period 5. Time period 6. So we receive $600 in advance. What's the entry going to look like on our books? These guys have prepaid rent $600 and they've given us cash. So what's it going to look like? They've given us cash, so we know we're going to be debiting cash. For what? $600. Now what do we credit? We know it's going to be $600, right? What are we going to be crediting for $600? Well, we owe them now for services. So we have a liability, right? We have an obligation to them. So it's going to be unearned income. Unearned income. It's going to be earned over the passage of time, but when we receive the money, the entry that we make on our books is to debit cash because somebody gave us a check for $600, and we have unearned income, unearned revenue, and we could even say unearned rent revenue or unearned rent income. But the fact is, this is now a liability, $600 on our books. Our accounting equation has not changed. Assets went up $100. Liabilities went up $100. So we have unearned income. Now we have to take that unearned income and spread it out just like that over a 6-month window. As 1 month passes, we will earn $100. As another month passes, we will earn $100. And up to 6 months, every month we will earn $100. So let's come back to our entry. Let's come back to our example here and draw a line. Draw a line. Because we talked about the adjusting entry up here when we pay the money in advance, prepaid rent. Debit prepaid rent, credit cash. What does the adjusting entry look like? The adjusting entry looks like this. We debit rent expense for $100 every month, and we credit the asset. We reduce the asset, so we credit prepaid rent. We looked at that in the last video. So what do we do down here? We're now the receivers of the money. What does our adjustment look like as the receivers of the money? Well, this unearned income of $600 has to get spread out. And we're earning $100, so we're going to credit, let's call it rental income or revenue. We're going to be crediting rental income for $100. And the question is, what are we going to debit? We're going to debit that liability. So we're debiting unearned income, which is the liability account. We're going to debit it for $100. We're going to credit rental income for $100. So the rental income of $100 will now show up on our income statement. And our unearned income on our balance sheet will not be $600. It'll be $600 less $100. A T account for unearned income would look like this. Unearned income. When we receive the money, we credit it for $600. When we made this adjustment, use a different color pen. When we made this adjustment here, that will show up as $100 right there, actually. It's debit unearned income for $100. And our balance in our account will now be what? $500. Because 600 less 100 is 500. That's going to be the balance that shows up on our financial statements. Had we not made this adjustment, the balance would have shown up as $600, and $600 is not accurate. It does not conform with generally accepted accounting principles, because we would not be recording revenue when it's earned and recognizing expenses when it's incurred. Can you see that we're taking this $600 and we have to show it now as it is earned, 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 earned. Then they would pay us another $600 in advance. We do the whole thing, whole process all over again. So here we have the second of 4 basic adjusting entries. And the first 2, I think the first 2 are the easiest, because the first 2 involve cash. We pay cash today. It's the Popeye example. I'll gladly pay you tomorrow. I'll gladly pay you tomorrow for a hamburger today. Well, we receive cash today, and we have to say, okay, we're going to pay the cash today. I'm losing track here. Number 1, we pay money today for services to be received over a period of time. The second one is we receive money today in advance for services to be performed over a period of time. These are 2 different sides of the same transaction, because the person who's paying the money, well, it's being paid to somebody who's receiving the money. And when a person is receiving money, it's coming from somebody who's paying money. So this is 2 different books, 2 different set of books. One is us, the tenant, and the other is the landlord we're paying money to. In the other case, we're the landlord, and the tenant is paying us the money. But how it gets handled is that these adjustments are being made at the end of every period. So in the next video, we'll look at the next 2 adjustments that we're making, and they involve what's called accrued expenses and accrued revenues. A little more tricky than these, but I think we can get it. See you in the next video.